So let me invite Dr. Iain Brown. He's the head of data science of SAS UK. And he is also the adjunct professor of marketing analytics at University of Southampton. In his presentation, he addresses the issue of black box machine learning techniques and their suitability for credit scoring processes. Based on research findings from a joint consortium academia, he approaches to solve his stress concerns of stochastic gradient boosting compared to the industry benchmark logistic regression that is proposed. So, Dr. Brown, let me invite you to the stage.
Welcome everybody to an interpretable machine learning approach to improved risk-based decisions. My name is Iain Brown and I head up the data science team for the SAS UK and Ireland function. As well as this, I also hold a position as adjunct professor at the University of Southampton. Today's session, we will be going through the topic listed. This is based upon some work we conducted as a consortium effort between the Edinburgh University and a large UK financial services provider called Nationwide. And this is based upon research on real-world risk data to derive and build a machine learning approach that's both interpretable, explainable, and robust over a time period. In today's session, I wish to give you three takeaways as part of the topic that we're going to discuss. This will focus to begin with on the market challenges that we see across EMEA and across the UK in particular, then move on to an interpretable approach to machine learning, a novel application of a topic called counterfactuals to best understand and describe the independent interactions of modeling components within the outcome space of a risk scorecard. And then finally, how you can unlock an improved decisioning matrix based upon these models that are being proposed and being analysed as part of the presentation. So what are the challenges and changes that are currently facing the financial services sector? Well, as you'll probably be familiar with, there's an increase in competition. There's a lot of organisations out there now offering lines of credit. This is both in traditional financial services sectors, in the banking sector. Also, we see this in retail, telecommunications, particularly from a UK perspective. We've seen a rise in what we see as digital or challenger banks that are offering different ways in which customers can bank with them without having necessarily a traditional bricks and mortar type approach where you have a branch to go into. As part of this, we've seen an increase in pressure on margins that organisations have to work within. Again, making it very difficult to be competitive where you have a number of others that are pushing down the price and pushing down the APRs or the interest rates that may be being offered. And obviously, particularly given now the situation we're all finding ourselves in, there's increased uncertainty within the market as to what may occur in the future and how banks may or financial service providers may need to operate. And competition is therefore, and particularly a competitive edge, is becoming more and more crucial for organisations to succeed and be successful in their endeavours within this space. If we take a step into the world of credit scoring, so the application of models to identify riskiness based upon attributes that we all hold and we all share with these financial services providers. As I mentioned, this is not just within the financial space. Typically, when you hear of credit scoring, you'd imagine this is used for personal loans, maybe if you want to take out a credit card, particularly if you want to have a mortgage, for example. But credit scoring is much wider than that. And we see this now applied as a methodology across multiple different sectors. And that will go into retail, for example, where you may be taking out terms of credit for a purchase of a product. It could also be within the telecommunications space, the digital space, where you may be taking out a new mobile phone contract. Again, as part of this, organizations will need to test your credit worthiness in order to offer you these lines of credit. So this impacts all of us. As individuals, we're all impacted by this. Organizations have done this for a number of decades to provide the best and most accurate decisions against their customers. But traditionally, this has been done in a very linear approach. An example of this is a traditional application scorecard. Now, this application scorecard I present to you here is based on a traditional logistic regression type approach, which is looking at linear interactions between a number of independent inputs and their impact on an external outcome. In this case, your ability to pay back on a loan, whether you're a high risk or a low risk. So we capture a number of characteristics about the applicant. It might be their age, residential status, their salary, how long they've been at a job, for example, how long they've been at their current address. And based upon those, typically organizations will attributize or bucket those characteristics into subcategories. So you will have attributes for age, attributes for residential status, and so on. Now, applying a traditional linear-based approach, this would generate a number of points based upon your riskiness. In this instance, the higher the points, the lower the risk, the lower the points, the higher the risk. So organizations can quite quickly start to determine, based upon your characteristics you're providing, whether or not you're high or low risk. And in this instance, we've got an applicant of an age of 32, they're a homeowner, and they've got a salary of around £30,000. And if we decided, based upon our prior behavior in our historical data, that we would only accept candidates that meet our criteria of 500 points, in this instance, we would accept them for credit because they've generated enough points based upon the characteristics they've provided. So this has always been the way in which banks have applied these kind of metrics to then calculate our riskiness. In terms of how this applies in a machine learning context, credit scoring, as mentioned, is very good to a certain extent at looking at the horizon of goods and bads and working out where the differentiation is in terms of your accuracy based upon usually metrics such as Gini to indicate how good that is in differentiating the good and bad customers. But as we all know or will have heard, that AI and machine learning is an approach that could be taken that will hopefully improve accuracy, particularly over traditionally linear type models. And we see this, and we've seen this for a number of cases within the financial services sector over the previous years, that applying, let's say, tree-based algorithms, so random forest, gradient boosting in this instance, you can get an uplift in terms of your accuracy. And particularly within Gini, we've seen this across organizations where a 10% Gini uplift over a new build scorecard is achievable. Now, this is great in terms of an accuracy. It means for organizations can make improved decisions. You're overall reducing the amount of loss potentially because you're better differentiating between those customers that are good and those that are bad customers. And you're also increasing revenue because you're able to loan out more money to those right customers and without having the loss associated to it. So there are some key benefits here, but there are also some disadvantages from a machine learning type approach is its transparency and its explainability. Typically, machine learning is seen as more of a black box, and this has its merits. A number of techniques that are used within the machine learning space use non-linear interactions between the data, and therefore it makes it much harder to explain what's actually going on under the covers of the model, particularly if you need to then explain that, in most cases, which you do, back to a customer as to why they may have been accepted or not accepted for a line of credit. So transparency and explainability have been barriers to entry for using these types of models, particularly where risk-based decisions are being made. Another challenge that has not been looked at as much within the literature is the robustness of these models over a time period. So building a model today, proving that it's more accurate than the current model is fine, but how will that apply over a period of time, particularly where you have financial instability and through a cycle that may include downturn, for example? And we are seeing this today. Impacts of COVID-19, we are potentially hitting difficulties within certain economies based upon this. So proving that a model is more accurate is one step, but proving it's robust and it's going to perform well over time is a very different aspect to it. So as part of the research that we conducted with Edinburgh University and nationwide, we wanted to challenge these two things: the transparency, explainability of the model, and then its robustness and stressing it over a period of time. Now, one of the approaches that we looked at applying here is a concept called counterfactuals. And this looks to explain the impact of explanatory variables on the outcome of the decision. It also helps in identifying model discrimination. So whether some of these independent variables are having an impact in a discriminatory way, we want to identify this. And as I mentioned, it is difficult, particularly where you've got nonlinear interactions within the data, to define whether or not this is having a positive or negative impact. If we take the example I presented on screen and look at the blue dot, this you can assume is a score that's been made, and this has been made by a machine learning approach. And this is agnostic. It could be applied to any machine learning approach. Once that score is made, what we want to do is, once it's been classified, derive how far that case would have been away from potentially being accepted. So in this instance, the orange dots over the horizon are counterfactual examples that would suggest that you would have been accepted had you been rejected at the blue dot. And this enables us to then clearly define to a customer to move yourself from that point to a point that could have been an accept. You would need to do something different. And in this case, if your income had been increased by £10,000 or $10,000, that would indicate you would have been accepted. And similarly, if we look at another example of this, it could apply on a multiple horizon period where you've got other variables impacting. And if you were to increase your more year of credit history, so wait a year, you would have also been accepted. So counterfactuals are a way to explain the behavior of the model that's applying a nonlinear effect, but also explain to the customer where you could have been if you were to change some of your features that you were applying within the system. So counterfactuals, I would suggest, and through the research, are a very stable way of applying these types of method. And actually, over the analysis that we did for a year's worth of data, stability-wise, these were actually more stable in the explanatory outcome than if you were to apply this within a risk-based scorecard approach using regression, which I'll come back to towards the end of the presentation. We also will need to look at stress testing of these models. So traditional approach would be to look at macroeconomic variables, understand their impact on the model, and then define whether those models are fit for purpose over a period of time. Now, you can do this in several ways, but if you want to apply this in a methodology where you're simulating new cases would increase or decrease the overall responsiveness, there is a methodology called k-nearest neighbors, which are used quite commonly in fraud cases to identify synthetic examples. So you're simulating outcomes of bad cases, let's say, to increase the severity of the model. So if we take the example that was applied in the research, we were able to perturb the data, i.e. create more probability of default, increasing the default population across the population that we had within the data sample, applying both a traditional regression approach as well as the stochastic gradient boosting. You can see that the blue line and the green line indicate out of sample and out of time. Out of sample being a random selection of a test set, out of time being a period of cohort of time that was saved to one side. They are less performant than the orange and subsequent red lines, which are the machine learning model. So as you're increasing the probability, learning context are more robust over the period of time and are providing an uplift over the standardized approach, which was great to see, and also proves that there is potential value here around not just the model accuracy, but also the stability of that model. Finally, to provide better decisions, this needs to be part of a model ops type or machine learning ops type framework. From this approach, models need to be more accurately calibrated and validated over time. And the suggestion here is this should be done more frequently. So even though there's robustness, by applying a more of a model ops approach, you can generate more accurate, more sustainable models over a period of time. And so in summary, the benefits of this approach, There's potential here to unlock more competitive decisions by pricing at a better level. Applying more transparent and robust approach to machine learning models enables wider acceptance and adoption across the business, even where potentially to generate these at a much more granular level, much more acceptable level in terms of their output and their transparency, could lead to opening the door to other applications of this across money laundering, across fraud, for example, as well as the applications of risk. So hopefully that you found that of use and interesting today. If you want to put any more information around the research and the findings that will be published soon, please reach out. But otherwise, I'm happy to take any questions and answers. Thank you.